Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Ayro stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Ayro designs and manufactures electric vehicles. Its vehicles are used by universities, medical campuses, resorts, hotels, hospitals, last mile delivery services, and food service providers. All models are environmentally friendly and are at a competitive price point. The Ayro 411 fleet is a family of electric, four-wheel compact, light-duty utility trucks sold exclusively through its contracted partner, Club Car. Each Ayro 411 vehicle is classified as a street-legal, low-speed vehicle that is capable of reaching speeds of at least 20 miles per hour, but not greater than 25 miles per hour. It has a range of up to 50 miles. This is all in line with the United States Department of Transportation regulations for low-speed vehicles and with most state statutes. The Ayro 411 fleet has zero gas emissions, a recharge capability of up to 6 to 8 hours, and it can carry up to 1,100 pounds. The cars in this fleet cost 50% less per year compared to similar sized gas-powered vehicles. So as you can see, most of their vehicles will be purchased for commercial use. Individuals like me and you probably would not buy these vehicles unless we lived in a big community like a retirement community or a big condo development, and instead of walking within the community, we could take one of their cars to get around. The company used to manufacture a three-wheeled vehicle called the Ayro 311, but sold the patents to another company last year. It is currently in development of an all-new three-wheeled electric vehicle to replace the Ayro 311. The company expects to begin manufacturing in the first half of 2022. It holds 2 design patents. Both were issued in February 2020 and will expire in February 2035. It also has numerous patent applications on file with the U.S. Patent and Trademark Office. It also filed 3 provisional patents in February of this year. It outsources its manufacturing to Karma Automotive. They signed a 12-month contract with Karma. Ayro is paying Karma $1.68 million in compensation plus warrants, which are options to purchase the stock for $3.19 per share. The warrants expire in September 2025. The company is headquartered in Round Rock, Texas, and was founded in 2015. It trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a microcap company, 106 million market cap. They're trading at $2.90 a share, and they have 36 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year since they're not bringing in much revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses, which is also negative each year. Revenue is a sales for the company, and that grows from $900,000 to $2.5 million. On a percentage basis, that's pretty big. It nearly triples. But on a dollar basis, it's pretty small. If the company's market cap was $10 million, I would say they're growing their revenue nicely, but the market cap is $100 million. So this is a pretty weak revenue number. This is the company's income statement. The top line is the revenue, the sales. In the third quarter of last year, their revenue was $389,000. Then it doubled to $783,000. Then it was flat the next quarter. And in the most recent quarter, it dropped a lot from the prior quarter. With such small revenue each quarter, you would expect big jumps, so that's not a great sign. Here's a breakdown of their 2019 and 2020 revenue. A bulk of their revenue is a sale of vehicles. They generated nearly $100,000 from charging companies for shipping. Subscription revenue went down a lot from $12,000 to $1,800. This looks like a good opportunity to generate revenue. This is through rental agreements. The company rents out its cars in different places, like resort communities. Golf courses will be a good place to rent their vehicles out as well. And service income, that also went down from 7,000 to 2,000. Since the company is so new, the vehicles aren't that old yet. But as time goes on, service contracts could be a big revenue generator for this company. Because most car manufacturers generate lots of revenue from services. And when you service a car, the margins are much higher than when you manufacture and sell the car. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That was positive in 2019, negative after that. Below that is their operating expenses and then our operating income, which is negative every year. They have very little debt on their balance sheet, so they have a small amount of interest to pay on the debt. And the bottom line of the income statement is their net income, which of course is negative every year. Here's a breakdown of their expenses from their 10K. So research and development, that grew from $714,000 to $1.9 million. They're always going to have research and development costs since they're always looking to develop new vehicles and improve their current fleet. Sales and marketing, $1.3 million to $1.4 million. Then G&A expenses, which is pretty steady at $6.5 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. And they spend a little bit in CapEx, $800,000 in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And since that's negative each year, they need money from somewhere to run their business. So they're doing it mainly with stock. They issued $2.5 million in 2019, $40 million in 2020, and $92 million in the trailing 12 months. They don't really use debt to fund their business. They're using mainly capital stock. And that's what you want to see when a company has negative operating cash flow. They're using stock to run their business, not debt. Because when you issue debt, you have to pay the interest on your debt. And then you have to take on more debt to pay the old debt, and it just gets worse and worse. It's best to issue capital stock and dilute the current shareholders, and then when you become profitable, then you could buy back that stock. But if you issue debt, it's going to take a lot longer to become profitable because you have to pay all those interest payments. This is the equity section of their balance sheet. They have $89 million of equity. They raised $127 million from selling their business, and they lost $38 million from running their business. So it looks like they have a lot of breathing room to run their business for a while before running out of cash. Let's look at the capital structure. $89 million of equity, $1 million of debt. They're 99% equity, 1% debt. Their net debt is negative $87 million, so they could pay off all the debt with the cash on their balance sheet and still have $87 million of cash left over. And their WACC is 10%, which is the middle WACC on Finbox, and that's a discount rate we're going to apply to the future cash flows. We estimated 5 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 5, that's $113 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $76 million. We divide that by 36 million shares. And we get a calculated stock price of $2.09. They're trading at $2.90, so they're trading at a 39% premium. It's a sell according to the model. The average analyst projects their revenue to grow 101%. I grew their revenue 101% a year for the next 5 years. That's how I got their future revenue estimates. And I figured they'd have negative free cash flow for the next 2 years. And then after that, it will be positive. The average company converts 10% of their revenue to free cash flow. So that's how I got their future free cash flow numbers. So it is difficult to value a stock with such small revenue. A lot is dependent on the contracts they get from bigger companies. If they could get a really big contract from a company like Walmart or a large resort, their stock price would go up right away. In the beginning of this year, the stock was well over $10. Anything that had the word EV in it, people were buying. So all EV stocks did really well in the beginning of 2021. When Biden got elected, all green energy stocks and cannabis stocks hit all-time highs. Once people realized the company wasn't bringing in much revenue, and it probably wouldn't for a while, there was a big sell-off, and now the stock is trading almost at its all-time low. The stock is up 2% in the past 52 weeks, while the S&P is up 30%. The 52-week low was 248, the high was 1150, and the stock is trading below its 50-day and 200-day moving average. 500,000 shares are traded on average in the past 3 months. Of the 36 million shares outstanding, 31 million are off float, 22% are held by institutions, and over 9% of the shares are shorted. The short percentage was a lot higher a few months ago, but it's been coming down as the stock price has been coming down. A bullish sign is when a company adds employees. And they are adding employees. They don't have a lot. They had 26 at the end of 2020. I'm not sure what they have currently. The biggest shareholder is Alpha Capital at 10%, then Invesco, Iroquois, Mark Adams, and the Vanguard Group. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is a little high at 21. They're not really bringing in much revenue at this point, and they have a really good price to book since they have so much cash on their balance sheet from all the capital raises. They have a really high current ratio and quick ratio. The company is nearly debt-free, so they have plenty of cash to work with. They have 88 million of cash on their balance sheet, and they're well capitalized. They had negative 16 million of free cash flow in the trailing 12 months, but they have $88 million of working capital, so they have $72 million of funding. So they can get through the next few years without needing any more cash. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 15 companies in the same industry as Ayro, and Ayro is better than average in price to sales and price to book. They have a really high current ratio, a negative ROE since they have negative earnings. They're really low in debt, but they're a tiny company, 100 million market cap. The average is 78 billion. Here's a comparison of Ayro with the other EV companies I've done videos on. GP makes EV buses, and New Technologies makes EV scooters. The other companies mainly focus on cars. What I like about Ayro is they have a niche. They're really focused on the commercial small truck industry. Most of these other companies, especially Tesla, are focused on individuals like me and you. The cars we drive every day to and from work, to get groceries, things like that. But there's a big market for what Ayro is doing, and if they can tap into that market, they could be a multi-billion-dollar company like a lot of these companies already are. Because look at the price to sales ratio. Ayro is at 21. Some of these companies have a worse price to sales ratio, or they're not much better, but every company is much bigger than Ayro. GP is 3 times the size, but these other companies are like 100 times the size. So there's a lot of upside for Ayro. So to summarize, I have them trading at a 39% premium, but that doesn't mean I wouldn't buy the stock, because it's almost impossible to value this company. I'm just using a lot of the stats that are out there today. But so much can change the stock price if they get a big contract, or if Biden announces he's going to put a lot of money into electric vehicles and the industry. So there's so many factors out there. And the fact this company has sales, that's a good thing. It does show interest. They obviously need to raise those sales to a decent number. I rank their free cash flows 1 out of 10, their revenue 2 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.